His name was Gerald, 73 years old, retired postal worker from Ohio. He spent 31 years delivering mail in the rain, the snow, the heat, building up his Social Security credits 1 year at a time. When Donald Trump stood up in front of millions of Americans and said the words out loud, "No tax on tips, no tax on overtime, and no tax on Social Security for our great seniors," Gerald cried. He actually cried. He called his daughter that night and said, "They finally did it. They finally did what they promised." He went to bed that night feeling like someone in Washington had finally seen him, finally remembered that people like him existed, that his 31 years of work meant something. And then tax season came, and Gerald sat down with his tax preparer, and she showed him the numbers, and the IRS was still taking money out of his Social Security. Not less, not nothing, still taking. And Gerald looked at his preparer and said, "But I thought they fixed it. I thought they passed the law." And she looked back at him with that expression that tax professionals across America have been wearing all year, that mixture of sympathy and frustration, and said, "They did pass a law. It just did not do what he said it did." If you are Gerald, if you are anyone who believed that promise, if you are sitting right now wondering why your Social Security is still being taxed after you were told it would not be, this video is for you. Stay with me, because I'm going to tell you the truth. Let us go back to the beginning, because understanding what happened requires understanding what was promised. In July of 2024, Donald Trump posted a message on Truth Social in all capital letters. He wrote, "Seniors should not pay tax on Social Security." Not a nuanced policy position. Not a complicated legislative proposal with caveats and conditions. Capital letters, exclamation point. Clear, simple, and absolute. The message spread like wildfire. It was shared millions of times, it was discussed on every major news channel, it was printed in newspapers from coast to coast. Seniors who have been paying federal tax on a portion of their Social Security income for decades, ever since Congress and President Reagan created the taxation structure back in 1983, finally felt like a promise was being made directly to them. And then Trump repeated it in his State of the Union address in February of 2026, saying, "With the great big beautiful bill, we gave you no tax on tips, no tax on overtime, and no tax on Social Security for our great seniors." He said it in the present tense. We gave you. Past tense. Done. Finished. Delivered. And millions of seniors believed it. Why would they not? A president standing in front of Congress, in front of the entire country, saying the words clearly and confidently. What reason would anyone have to doubt it? Here is what actually happened. In July of 2025, the One Big Beautiful Bill Act was signed into law. It was a massive piece of legislation, hundreds of pages, covering taxes, spending, deductions, and dozens of other policy areas. And buried inside that legislation was a provision for seniors. It was called the Senior Bonus Deduction, and it is real. It is a genuine new tax break that tens of millions of seniors can use starting with their 2025 tax return filed in 2026. But here is the critical detail that changed everything. The One Big Beautiful Bill did not eliminate taxes on Social Security. It did not repeal the formula that determines how much of your Social Security benefit is taxable. It did not touch the income thresholds that have been in place since 1983 and 1993. The three-tier structure that decides whether you pay taxes on 0%, 50%, or 85% of your Social Security income, that structure is exactly the same today as it was before the bill was signed. Not one word of it changed. The Institute on Taxation and Economic Policy, a nonpartisan research organization, reviewed the legislation and stated plainly that there are no changes to the way Social Security benefits are taxed under the federal income tax law in the new bill. Zero. None. So what did the senior bonus deduction actually do? And does it help? The honest answer is yes. It helps some seniors, but it is not what was promised, and it is not equally helpful for everyone. Here is how it works. The senior bonus deduction gives taxpayers who are 65 or older an additional $6,000 that they can subtract from their total taxable income. If you are married and both you and your spouse are 65 or older, that doubles to $12,000. This deduction comes on top of the regular standard deduction you already receive. So when you file your taxes, you subtract more income before the IRS calculates what you owe. For some seniors, particularly those with lower incomes, this extra deduction is large enough to bring their taxable income down to zero. And if their taxable income is zero, they effectively pay no tax at all, including on their Social Security. For those seniors, the deduction does deliver the practical result of paying no tax on Social Security. But it does not do that for everyone, and for millions of seniors who earn more than certain income thresholds, the deduction helps but does not eliminate the tax entirely. And for seniors whose income is above the phase-out limits, $75,000 for single filers, $150,000 for married couples, the deduction starts shrinking and eventually disappears entirely. Let me tell you about Dorothy. Dorothy is 68 years old. She lives in Florida. She retired after 30 years as a school librarian. Her Social Security benefit is $22,000 per year. She also receives a small teacher's pension of $16,000. Her total income is $38,000 per year. Under the old rules, before the Big Beautiful Bill, Dorothy paid federal tax on a portion of her Social Security because her combined income was above the threshold where Social Security starts becoming taxable. She was not wealthy by any standard. She was a retired librarian, but the IRS still took a portion of her check every year. Under the new rules with the senior bonus deduction, Dorothy subtracts an extra $6,000 from her taxable income. Combined with her regular standard deduction and her existing age-based extra deduction, her total deductions now exceed her gross income. Dorothy owes zero in federal taxes. For Dorothy, the promise came true, not because Social Security taxes were eliminated, but because the new deduction was large enough to wipe out her tax liability entirely. Dorothy is one of the 88% of Social Security recipients that the White House claims will pay no federal tax on their benefits under the new law. Dorothy's story is the good news version of 2026. But now let me tell you about Robert. Robert is 71 years old. He lives in Texas. He retired after a career in manufacturing management. He receives Social Security of $30,000 per year, a pension of $35,000 per year, and takes mandatory withdrawals from his IRA that add another $25,000 to his income. His total income is $90,000 per year. Under the new rules, Robert's income of $90,000 as a single filer means his senior bonus deduction is partially phased out. It starts disappearing above $75,000. He gets a reduced deduction, not the full $6,000. And because his combined income is well above the $34,000 threshold, where 85% of Social Security becomes taxable, the IRS includes nearly $25,500 of his Social Security benefit as taxable income, same as it did last year and the year before and the year before that. Robert is not a wealthy man. His $90,000 income barely covers his mortgage, his medical costs, his property taxes, and the basic expenses of retirement in Texas. But the IRS still taxes his Social Security, and the new law did not change that for him one bit. Robert is part of the 12%, the millions of seniors for whom the promise was not kept. Here is a number that should make every American angry. Not at a political party, not at a president, but at the fundamental dishonesty of the way this policy was communicated to the people it was supposed to help. According to the Social Security Administration's own data, approximately 40% of Social Security beneficiaries currently pay some federal tax on their benefits. That is roughly 28 to 30 million people. The White House claims that under the new law, 88% of Social Security recipients will pay no tax on their benefits. If that is accurate, and there is genuine debate among economists about whether that number is overstated, then approximately 12% still will. 12% of roughly 70 million Social Security recipients is more than 8 million people. 8 million Americans who heard the promise, believed the promise, and are now sitting with their tax returns realizing the promise was not kept for them specifically. And even for the 88% who do benefit, the reason they pay no tax is not that Social Security taxes were eliminated. The reason is that the new deduction was large enough to offset the taxes. Those are two completely different things. One is a structural change that protects seniors permanently. The other is a temporary deduction that expires after 2028 and requires you to actively claim it on a new form called Schedule 1A, which most seniors still do not know exists. Let me explain the technical details in a way that makes this completely clear, because I know that tax law can feel like it was designed to confuse people. And honestly, sometimes it is. The rule that determines how much of your Social Security is taxable has two thresholds. For single filers, if your combined income, which is your adjusted gross income plus tax-exempt interest plus half of your Social Security, is below $25,000, none of your Social Security is taxable. Between $25,000 and $34,000, up to 50% of your Social Security can be taxable. Above $34,000, up to 85% of your Social Security is taxable. For married couples filing jointly, those thresholds are $32,000 and $44,000. These numbers have been exactly the same since 1993, more than 30 years ago. They have never been adjusted for inflation. They have never been updated to reflect the fact that Social Security benefits themselves have risen significantly through cost of living adjustments over the decades. Every year, because benefits go up but the thresholds stay the same, more and more seniors cross into the taxable range for the first time, even without any increase in their real purchasing power. The One Big Beautiful Bill changed none of this. Not the $25,000 threshold, not the $34,000 threshold, not the 85% maximum. Every single number is identical to what it was the day before the bill was signed. Now, I want to address something that I know is going to be on the minds of some people watching this video, and I want to address it directly and fairly. Some people will say, the president delivered real tax relief to seniors. The senior bonus deduction is real money. 88% of seniors paying no tax on Social Security is a significant achievement. And those people are not entirely wrong. The senior bonus deduction is real. It does help millions of seniors. For low and moderate income retirees like Dorothy, it genuinely delivers a tax bill of zero, which is the practical equivalent of not paying tax on Social Security, even if the technical mechanism is different. I am not here to attack any political figure or any political party. I am here to give you accurate information so that you can make smart decisions about your money. And the accurate information is this. The structure of Social Security taxation was not changed. A new deduction was added that helps many seniors, but not all seniors. The deduction is temporary. It expires after 2028. It requires active claiming on a new form. And the people who need this information most, the seniors who are still paying tax on their Social Security and do not understand why, deserve to have someone explain it to them clearly, without spin, without political cheerleading, and without the kind of oversimplification that led Gerald to cry tears of relief over a promise that was never fully kept. Let me walk you through exactly how to figure out where you personally stand on the Social Security tax question. Pull out your most recent tax return, specifically your Form 1040 from your 2025 filing. Find line 6B. That is the line that shows the taxable amount of your Social Security benefits. If that line has a number greater than zero, the IRS is including a portion of your Social Security in your taxable income. That means you are in the group of Americans who are still paying tax on their benefits. Now look at your total tax on line 24. If that number is zero, then even though Social Security is partially counted as income, your total deductions, including the senior bonus deduction if you claimed it, brought your tax bill to zero. That is the best case scenario. But if line 24 shows a tax liability, if you paid federal taxes, and if line 6B shows taxable Social Security, then you are in the group for whom the promise was not fully delivered. You have the right to know that. You have the right to understand why. And you have the right to know what, if anything, you can do about it. For seniors who are still paying tax on their Social Security despite the new law, there are a small number of strategies worth discussing with a tax professional. The first is making sure you are claiming the full senior bonus deduction. If your income is below $75,000 as a single filer or $150,000 as a married couple, and you did not file Schedule 1A with your return, you may have overpaid, and filing an amended return could get some of that money back. The second strategy involves managing your overall income level. For seniors who are taking large IRA withdrawals in addition to their Social Security and pension, strategically reducing IRA withdrawals in high-income years can sometimes bring combined income below the threshold where Social Security becomes heavily taxed. This requires working with a knowledgeable tax advisor, but for the right situation, it can save thousands of dollars. The third strategy is a Roth conversion, gradually moving money from a traditional IRA to a Roth IRA over several years, so that future withdrawals do not count as income. This is a long-term strategy that takes years to implement, but can meaningfully reduce Social Security taxation in retirement over time. I also want to talk about what the expiration of the senior bonus deduction means for seniors who are relying on it, because this is a planning issue that almost nobody is talking about. The senior bonus deduction is written as a temporary measure in the One Big Beautiful Bill. It applies to tax years 2025, 2026, 2027, and 2028. After 2028, it disappears unless Congress acts to extend or make it permanent. That means if you are a senior who is currently paying zero in federal taxes because the deduction is wiping out your liability, in 2029, if Congress does nothing, your tax bill will jump back up to whatever it would have been without the deduction. You will not receive a letter warning you this is coming. The IRS will not send you a reminder. Your tax preparer will simply show you a higher number in January of 2029, and you will be left wondering what changed. This is not a hypothetical risk. This is a scheduled change written into the law as it was passed. Planning for this now, while you still have time, is one of the most important financial decisions a retiree can make in 2026. Here is something personal I want to share, because this video is not just about tax policy, and it is not just about numbers. It is about trust. It is about the relationship between the American government and the American retirees who built this country. Social Security is not a handout. It is not a benefit. It is a return on a mandatory contribution that every working American makes their entire career. The money was taken from every paycheck you ever earned, before you could spend it, before you could save it, before you could invest it. The promise made to you when that money was taken was that it would come back to you in retirement as a stable, reliable income. And now, in retirement, the same government that took that money is taxing it again when it comes back to you. That is a double taxation. It was controversial when it was created in 1983. It was controversial when it was expanded in 1993. It remains controversial today. And the presidents who promised to end it, loudly, clearly, in capital letters, did not end it. He added a deduction that helps many seniors, but left the structure intact. Whether that was the right policy decision is a debate for economists and politicians, but you deserve to know the truth of what happened. That is why this channel exists. Let me now address the question that I know is on the minds of millions of seniors across America right now. Is there any realistic chance that Social Security taxes will actually be eliminated in the future? The honest answer is, it is possible, but not likely in the near term, and the obstacles are significant. The reason Social Security benefits are taxed is that the revenue from that taxation goes back into the Social Security Trust Fund, helping to keep the program solvent for current and future retirees. If Congress eliminated the tax entirely, it would need to find another source of revenue to replace what the Social Security Trust Fund would lose. The Congressional Budget Office has estimated that fully eliminating the taxation of Social Security benefits would reduce federal revenues by several $1 trillion over a 10-year period. That is an enormous gap to fill. Some proposals have suggested offsetting the costs with cuts to other programs or with new forms of revenue. But none of these proposals have achieved the bipartisan support needed to pass in recent sessions of Congress. The senior bonus deduction was the compromise, a partial relief measure that helped many seniors without requiring the full elimination of Social Security taxation and the revenue replacement challenge that would require. Now I want to give you the most practical information I can about where things stand right now in 2026 and what you should actually do. If you have already filed your 2025 tax return and you did not include Schedule 1A with the senior bonus deduction, the first thing you should do is check whether you qualify for it. If you are 65 or older and your income is below $75,000 as a single filer or $150,000 as a married couple, you likely qualify for at least a partial deduction. If you did not claim it, you may be able to file an amended return using Form 1040-X to claim the deduction and potentially receive a refund. An amended return must be filed within 3 years of the original filing date. The refund for a missed senior bonus deduction could be anywhere from a few $100s to over $1,000, depending on your tax bracket. That money belongs to you. Do not leave it with the IRS simply because your original preparer did not know about Schedule 1A. If you have not yet filed your 2025 return and you are still within the extension period, which runs through October 2026, make absolutely sure that Schedule 1A is included and that the senior bonus deduction is properly calculated. This is the single most important thing you can do to reduce your federal tax bill this year. Let me also say something to the seniors who feel angry after watching this video. You have every right to feel angry. You were told something clearly and simply that turned out to be more complicated than it was presented. You planned your retirement finances around an expectation that did not fully materialize. You told your family and your friends about the promise. Maybe you even felt for the first time in years that Washington was paying attention to you. And then the details came out and the reality was different from the headline. That anger is legitimate. But here is what I want to ask you to do with that anger. Use it as motivation to become more informed. Not just about Social Security taxes, but about every financial rule that affects your retirement income. Because the difference between a senior who knows the details and a senior who relies on political headlines is often thousands of dollars per year. The system is complicated by design. Understanding it is your best protection. And that is exactly why this channel exists. To translate the complicated into the clear, and to make sure that the information that expensive tax professionals charge hundreds of dollars to provide is freely available to every American who needs it. The story of Gerald, the retired postal worker from Ohio, does not end with disappointment. It ends with action. After his tax preparer showed him that his Social Security was still partially taxed despite the headlines, Gerald did not just accept it. He asked questions. He found out about the senior bonus deduction. He found out that he needed to file Schedule 1A. His preparer amended his return, and Gerald got back over $800 that the IRS had been holding because the form had not been included originally. He did not get zero taxes on his Social Security because his income was above the threshold where some tax still applied even with the deduction. But he got $800 back that was rightfully his, and he told his daughter, "At least I know the truth now. At least I know what to fight for." That is what knowledge does for you. It does not always give you exactly what was promised, but it always gives you the ability to claim what is actually owed to you. And right now, what is owed to millions of American seniors is a real, substantive, permanent elimination of the Social Security double tax, not a temporary deduction with an expiration date. Until that happens, this channel will be here every day, making sure you know exactly what tools you have, what forms you need to file, and exactly how to keep as much of your own money as the law allows. Subscribe so you never miss an update, because in 2028, when that senior bonus deduction is scheduled to expire, you are going to want to know about it well in advance. There is one more piece of this story that almost nobody is talking about, and it may be the most important financial warning for American seniors in 2026. The Social Security Trust Fund is running out of money. This is not a political opinion. This is an actuarial fact published by the Social Security Administration's own trustees in their annual report. The current projection is that the Social Security Trust Fund will be depleted by approximately 2033, just 7 years from now. When that happens, if Congress has not acted to shore up the program, Social Security benefits for all recipients could be automatically cut by approximately 23% across the board. That means a senior receiving $2,000 per month today would receive approximately $1,540 per month. Not because of any new law, not because of any political decision made at that moment, but simply because the math of the trust fund runs out. Now, here is the connection that nobody is making clearly enough. Every dollar of Social Security tax revenue that is not collected because of deductions, exemptions, or the eventual elimination of Social Security taxation, if it ever happens, makes the trust fund depletion problem worse, not better. The Newsweek article from August 2025 quoted financial literacy expert Alex Bean saying, "While this certainly could benefit some seniors, it could further escalate problems with solvency. With Social Security's funding scheduled to encounter a shortfall in the next few years, worries over further additions for existing beneficiaries and future ones, while certainly good for those individuals, could further complicate the long-term viability of the program." In simple words, The very tax relief that seniors were promised could, if fully delivered, speed up the day when Social Security can no longer pay full benefits to anyone. This is the uncomfortable truth that lives beneath the headline of the promise. And every senior who is planning their retirement finances needs to have this information, not to make a political judgment, but to make realistic plans for what their income might look like in 2033 and beyond. Let me talk about something that happened in living rooms across America this tax season that breaks my heart every single time I hear about it. Seniors, real people, decent, hardworking people, who heard the promise, believed the promise, and then made financial decisions based on it. Some of them told their children they would not need financial help this year because their taxes were going to zero. Some of them budgeted for home repairs or medical procedures they had been putting off because they expected a larger refund or a lower tax bill. Some of them canceled their appointments with tax professionals because they assumed the new law was simple and automatic and they would not need help figuring it out. And then reality arrived.